Hey there! If you're earning money in India, then this one's for you. We're going to tackle the world of income tax. I know, it can seem super confusing, but stick with me. We're going to break it all down so you know exactly what's happening with your hard-earned cash.
All right, before we dive into any of the math, let's just start with the biggest question of all, right? Why do we even pay taxes in the first place? I mean, it can feel like just this chunk of money vanishing from your paycheck every month. But here's the thing, it's not vanishing. It's actually the fuel that keeps the whole country running. We're talking everything from roads and bridges to schools and hospitals.
Okay, so you should know not all taxes are created equal. You can pretty much split them into two main types. First up, you've got direct tax. This is super straightforward. It's your income tax. You earn the money, you pay the tax on it directly to the government. Simple as that. Then there's the other kind, indirect tax. Think of GST. When you buy something, a company has already paid that tax, but they just add it to the price you pay. So you're still paying it, but, in a roundabout way.
Now, they're both obviously important, but for today, we're going to zero in on that first one, the direct tax, the one you pay on your own earnings, income tax.
There's this great quote that says taxes are the cost of living in a society. And that really hits the nail on the head, doesn't it? That money isn't just disappearing into some black hole. It's paying for our national defense, it's paving the roads we drive on every single day, and it's funding crucial stuff like our schools and hospitals.
Okay, so we've got the why covered, but what about the how? Who actually makes up all these rules about how much we pay, and on what exactly? Well, there's a whole rule book for that. Let's take a peek inside.
The easiest way to think about this is like a really complex recipe. It's got 5 main ingredients. First, you've got the main recipe book itself, the Income Tax Act of 1961. That's the foundation. Then, every year, the Finance Act comes along and adds some yearly updates, like a new spice. Then you have the income tax rules. That's the super detailed, step-by-step instructions. If things get confusing, circulars and notifications are sent out as official clarifications. And finally, if there's a debate about what the recipe really means, court rulings act as the expert chefs who give the final interpretation.
But out of all of those, the big one, the cornerstone of this whole thing, is the Income Tax Act of 1961. Seriously, this is the main law. It's kind of like the source code for everything else we're going to talk about today.
All right, enough with the theory. Let's get into the part you've probably been waiting for, the numbers. How is your tax actually calculated? Well, it all kicks off with one simple idea, adding up everything you've earned.
See, the tax department doesn't just see one giant pile of money. They organize it first. They take everything you earn and sort it into one of these 5 main buckets. You've got your salary, any rent you might get from a house, profits from a business, capital gains, that's money from selling things like stocks or real estate, and then there's a final bucket for other sources, which is basically a catch-all for anything else, like the interest you get from a savings account.
So, step 1 is super simple. You just take all the money from those 5 buckets and, metaphorically, pour it all into one big container. That total is your starting point.
But, and this is a big but, you don't pay tax on that entire amount. Nope. The next step is all about refining that number. We need to get from what's called our gross total income down to the final number that really matters.
Think of this next part like a 3-step filter. Step 1, you pour all that income we just talked about into the top. That's your gross total income, or GTI for short. Step 2 is where the magic happens. The filter subtracts any eligible deductions you have. We're talking about things like specific investments or payments. And what comes out at the bottom? That's your total income, or TI.
And that final number, your total income, is the one you need to remember. This is the big one. Forget the gross amount you started with. This is the actual amount your tax is going to be calculated on.
Okay, so you've got your magic number, your total income. But now what? Well, here's where it gets interesting. How you actually pay tax on this amount isn't just one single path. You actually have a choice to make.
Yep, the tax system basically puts a fork in the road in front of you. You have to pick one of 2 paths, or what they call regimes. You have the default regime, which is the newer one, and then you have the optional regime, which is the older system. So what's the difference? Let's break it down. It really boils down to one simple trade-off. If you pick the default regime, you get to enjoy lower tax rates. Sounds great, right? But the catch is, you have to give up most of those deductions we talked about. On the other hand, if you go with the optional regime, the tax rates themselves are higher, but you get to use all those juicy deductions to bring your taxable income down. So let's look at the default regime first. As you can see, if you earn up to 3 lakh rupees, you pay nothing, zilch. After that, the rates go up pretty gradually, 5%, then 10, and so on.
But here's the real kicker. If your total income is 7 lakh rupees or less, there's a special rebate that makes your final tax bill 0. That's a huge deal.
Now, let's switch gears and look at the optional regime. Right away, you can see the tax-free limit is lower, only 2.5 lakh. And whoa, look at that jump. As soon as you cross 5 lakh, the rate leaps from 5% all the way up to 20%. It's a way steeper climb, for sure.
We are almost at the finish line, I promise. There are just a few final touches to your tax bill. If you're a really high earner, there's an extra tax called a surcharge. For folks on the lower end, that rebate we talked about can slash your tax bill. And then, finally, everyone, no matter what, pays a 4% health and education cess that's tacked on to the final tax amount.
So, after all of that, it all boils down to one massive question. A question you have to ask yourself every single year.
And that question is this. Do you have enough deductions to make going with the optional regime, with its higher rates, actually worth it? You've got to think about things like, do you have big investments, a home loan, are you paying tuition fees? If you have a ton of those deductions, the optional path could still save you money despite the higher rates. It's a math problem that, really, everyone needs to run for themselves.
Look, at the end of the day, understanding all this stuff isn't just about ticking a box for the government. It's genuinely the first step toward feeling empowered with your own money. It puts you back in control. I really hope this has helped lay down the groundwork for you. So the only real question left is, what's your next step going to be?